This Wednesday sees the latest FOMC interest rate decision coming in a week where we see a whole raft of central banks coming to the fore. Of course, there's a huge amount of uncertainty, and that really makes for a patient approach for central banks. And certainly the question marks right now all revolve around inflation. Well, the decision itself doesn't necessarily look all that interesting, but what will be interesting will be the economic projections that come alongside it, the dot plot and alike. And so let's look into the forthcoming FOMC interest rate decision to see exactly how it can shape markets. Here we go. This is the market expectations according to the CME, currently pricing essentially flat rates at 350 to 375 for the vast majority of this year. Might get a rate cut at the back end of the year. Remember, previously it was talk of 2 rate cuts, and then thinking, Kevin Walsh, if he comes in, is he going to be able to convince the group? I'm an ultra hawk, but in actual fact, I think we need to ramp up easing. That was the talk not so long ago. And now everything that's happened in terms of Iran portrays a very different picture. Inflation expectations are soaring. That, of course, has a huge knock-on implication for the outlook from the Federal Reserve. Some people might say the Fed are going to look through it and say it's not something we can address, energy prices. But ultimately, energy prices permeate throughout the economy and have knock-on implications. So things that they can impact ultimately do get affected. So as things stand, it looks like markets are essentially pricing a uncertainty, and this is going to shift. And as these prices shift, so we see shifts in terms of markets across the board. And I'll show you exactly that in a chart to highlight exactly how the shifting expectations will impact the different markets. So here is the dot plot. Remember, we've got the economic projections and the dot plot alongside the rate decision this time around, which makes it particularly interesting. And you can see what's notable about the December plot that we have here is the indecision across the board. What you want generally as a governor is that you influence the group enough that there's some consensus around different factors, like where do we think interest rates are going to go? Well, right now, there's a very wide spread in terms of that view. As you can see here, each dot represents the view of each member in the FOMC. And so you've got a very wide spread of where rates are going to go from here. They could go down. That is the sort of overall consensus, but how much, that remains to be seen. And certainly those dots will have shifted from that meeting to now. So certainly this will be an interesting part to look for as to say whether it was a hawkish or a dovish meeting. And you can see here the overall projections as we see from the December meeting here. But then we'll see this exact same table on Wednesday alongside the announcement. And therefore you can, as you see here, the September projections, you can essentially compare where the December projections were and where they are now. The caveat, of course, is if we say core PCE price index and PCE inflation, if suddenly that sort of sharply rises in terms of their projections, you could say this is very hawkish. That should be beneficial for the US dollar, for example, negative for gold. But the caveat here is that they don't really know any more than anyone else, right? Like they don't really know how long this is going to go on for. They don't know the implications in terms of inflation. So ultimately, it's a guessing game. And what these projections look like now are probably going to be very different from reality, number one, and very different from the projections in a few months' time. Nonetheless, markets will just go on what they have in front of them. Therefore, if we see sort of upward revisions in terms of the expectations around unemployment or upward revisions in terms of inflation, these are the kind of things that really impact market expectations around rates. And so really it's a case of adjustments to rate expectations off the back of those projections, economic projections. So I just wanted to bring you the charts, the graphs from the December projections. And you can see here a gradual move lower in terms of the core PCE and the headline PCE. And then GDP in real terms, not too different from where we are at the moment. And unemployment, similarly, not really expected to continue rising, just a sort of flat unemployment. And to some extent, it's just a cop out. because if someone says, can you project where such and such is going to go, and just say, probably just stay around where it is now, to be fair. Nonetheless, that's where we are at the moment. So certainly if we see any notable change in terms of expectations going forward, in particular for the inflation slides, then that will be a notable thing that markets could jump on in terms of the outlook. Now, you can see here in terms of the trueflation metric, this is a private metric of inflation. What's good about this is it's produced on a daily basis, and it takes into account a whole host of everyday factors and prices, and it feeds it into it. Now, this dropped as low as I think something like 0.7. Yeah, so you can see 0.68 on the year-to-date low. Now it's up to 1.54. So notably, inflation pressures have been ticking up already, according to the trueflation metric. And that has a significant knock-on implication, given the fact that the Federal Reserve had the dual mandate of keeping unemployment under control and inflation under control. If we see a resurgence in inflation, that's what has the major knock-on implications. And that's why we've been seeing the moves we have within the markets, and why we're seeing the shifts in terms of market pricing. In terms of the US dollar, this is one thing I wanted to bring to your attention. I could do a separate video in terms of the potential for a resurgence for the dollar, given everything that's happening, and maybe I will. But certainly this is worth bearing in mind. The trajectory of the US dollar under Donald Trump, the first time around and this time around, I mean, it's been playing out absolutely perfectly thus far. We didn't necessarily get that consolidation phase, but the US dollar turning higher at the moment. And certainly if we see inflation on the rise and we see this conflict drawn out, I wouldn't be surprised to see the US dollar gaining ground from here on, playing out much like we saw that previous time around with following the 2016 election win from Trump. Let's just jump onto the charts and see exactly what's what. So first and foremost, I just wanted to show you that the wider context in terms of what's influencing what at the moment. The candles are Brent crude, and the lines are the Dow Jones Industrial Average, the dollar index, the US 2-year, and gold. And we can see they're moving largely in tandem, and I have inverted some of them. So bear that in mind. Bear in mind that the likes of the Dow Jones Industrial Average and gold are both inverted. The rest of them are not. Nonetheless, what this essentially means is all of these markets are related. So if you think you're trading the dollar, well, you're also trading oil, and you're also trading gold. I mean, it's all the same narrative right now, and it's all being led really by oil. If oil continues to rise, it should be beneficial for the US dollar. It should see further upside in terms of the US 2-year, and weakness for equities and gold. Now, of course, the caveat is we're coming into an FOMC meeting that could shift the narrative away from oil. Doesn't necessarily mean that oil won't be important. It just means at that moment in time, if we saw something notable that maybe reiterates the point being made by oil, right? So if oil rises, people become fearful around inflation, and therefore we see the US 2-year yield on the rise. Therefore, we see the US dollar rise. We see gold selling off, equities selling off. So if we see an interest rate decision that, say, they keep rates steady, which markets are expecting, that essentially will happen. But aside from that, we see economic projections that point towards a sharp rise in terms of inflation, and the economic projections in the dot plot for interest rates suddenly are much higher. That kind of factor can move rate expectations. So it will move the 2-year, and it's almost going to skip the move in oil. So right now, oil goes to the 2-year, goes to the US dollar, goes to equities and gold. If we see something tangible that moves the market around this meeting, it's almost going to skip that first step, which is oil, and go straight to the 2-year yield. So the 2-year yield is a good reflection of exactly where rate expectations are right now. And so if we go on to, say, euro dollar, and we'll go on to the US 2-year, we'll get that on. If it wants to go on, here we go. So essentially, we've got this inverse correlation right now. If I invert it, you can see that this is how it's playing out at the moment. So essentially, if the 2-year yield is on the rise, so is the value of the US dollar. So right now, this signals the possibility of further upside for the dollar, further the weakness for euro dollar. We can see from a wider perspective, this is how things are shaping up. Let's look at the monthly. So here's how things are shaping up. The long-term trend is bearish. The recent rally that we've seen under Trump has taken us towards, but not through, the major prior swing high that comes around here, 1237. And now, notably, we're breaking back below your first swing low here at 1148. That points towards a possibility that we've topped out. So we're regaining a bit of ground in this current week, but this does point towards a possibility of more of the same. And certainly that is a play on the idea that we're going to see a hawkish outlook from the Federal Reserve. We're going to see inflation rear its head once again. And certainly that is the narrative at the moment for sure. Whether that's how it plays out or not remains to be seen. But certainly as time goes on, there's more and more destruction in terms of oil and gas facilities anyway. And that, of course, has a tangible impact, even if we do see a resolution to the conflict. So euro dollar on the rise at the moment, unless we break the 11668, then I think it's likely that's going to be a retracement before the bears come back into play once again and continue this dollar strength narrative that has been building recently. The caveat, of course, is maybe this is a super dovish meeting. It's not going to be. Maybe this is, we're on the cusp of a breakthrough on the Iran issue. That may be the case. We don't necessarily know. I mean, it's the whole taco thing. I mean, ultimately, Donald Trump could pull the plug on the whole thing at any moment and suddenly see a reversal of many of these moves, which could lead to a sharp rise. But I don't see a Federal Reserve meeting that's going to be particularly dovish, and therefore we have the basis for further dollar strength around that meeting. In terms of equity markets, we can see here how our rate expectations impact in this. Once again, we've got this inverse correlation, so we'll invert it. We've got that inverse correlation, and so whilst we're regaining ground for equities at the moment, that is really a function of the rise that we've been seeing in terms of two-year yield, which in turn is a function of the moves that we're seeing in terms of crude. Let's just throw the crude on and invert it. Invert. Oh, inverted the wrong thing. Lots of inversion. There we go. So there you go. It's one and the same. So in any case, crude's pulling back a bit. We're seeing the two-year pulling back a bit, and we're seeing equities on the rise. But I do think as long as this conflict continues, there's risk of further downside. Now, if we saw the FOMC meeting coming out in a dovish sense, then yes, we could see further upside in terms of equities. I think more likely we see the opposite. We saw a hesitancy, a caution, a dot plot that doesn't necessarily spell out many rate cuts to come, and economic revisions that point towards additional inflation, and that would be negative for the US markets. And so let's look at the moment. You can see we're regaining a bit of ground, but essentially I would see that as a sort of retracement of this move. So unless we break the 48219 mark, then near-term gains I think are likely to be short-term in nature. And then finally, looking at gold, it's a similar kind of story. I can jump on and throw any of these on. The two-year yield's going to work, but we could just look at this and we can say, we've got that same relationship with crude at the moment, which essentially is the same as the 2 years, same as the dollar. So more of the same. So certainly at risk of further downside to come with gold. You can see exactly here how we've seen that breakdown through support here. But then, are we making a wider retracement here? Possibly, but then we see this kind of pattern here. So we don't break to the new high. We see support, and then we see the breakdown through support. That points towards near term, this consolidation faltering into another move lower from here. From a wider perspective, I do think there's a chance that what we're seeing at the moment is a retracement into this zone, and then the bulls come back into play, and that would just be a sort of reversion to mean move. So sort of 4,800 possibly is the kind of area we'll be looking at. Depends on how long it takes, really. 4,800, 4,850, that kind of area. So I do think there's another leg lower in this, and that really kind of tallies up with the idea that I think it's probably going to take a little bit of time for the conflict in Iran to resolve. But certainly, hawkish Federal Reserve should lead to a weakening of gold. And certainly, as we're sort of consolidating at the moment, it certainly doesn't look great. It looks pretty at risk because we've seen that sharp decline. We haven't retraced much of it, sort of consolidation. So certainly a breakthrough this area of lows, 49.70. Looks like it could point towards further downside to come. That's it for today. Make sure you like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.